On a Friday night last month, at 1 minute before midnight, a clock ran out in Washington. There was no ceremony, no pen, no photograph of anybody signing anything. The president did not sign it. He also did not veto it. He simply let the clock expire, and at midnight, the largest housing law in about 30 years became the law of this country anyway. Verified card. Source. The 21st Century Road to Housing Act became law on July 11th without a presidential signature after the 10-day constitutional window expired. Most people found out days later, if they found out at all. Now, I want to be honest with you about that law from the very first minute of this video, because a great many people are about to tell you things about it that are not true. It caps the big investment firms. A company that already owns more than 350 houses is now blocked from buying more single-family homes. Verified card. Source. The law restricts institutional investors owning more than 350 single-family homes from acquiring additional single-family properties. It opens up small mortgages for smaller houses. It clears out building rules that were slowing construction down. And here is the part nobody wants to say out loud. None of that puts a single dollar back in your pocket this year. It does not lower your property tax. It does not lower your capital gains. It does not touch your assessment or your escrow or your insurance. It is a supply law. It is aimed at the market 5 and 10 years from now. So if you are 60 or 70 or 80 and somebody tells you that Congress just did something for you, that is the honest answer. They did something. It was real and it was big. It was just not for you. But 3 other things are moving right now that are aimed directly at you. And that is what this video is actually about. Now, before I walk you through them, I want to give you the single most useful idea in this entire subject, because once you see it, you will never be fooled by a headline about this again. Every one of these proposals comes with a number attached. $1 million, 0 property tax, full exemption. The number is what makes the headline. The number is what gets repeated. And in every single one of them, there is one sentence further down that decides whether the number applies to you or not. That sentence is never about your income. It is almost never about your house. It is about time. How many years you have owned it, how many years you have lived there, how many years since your husband or your wife died. The number is the advertisement. The calendar is the law. And I am going to show you 3 of these, and in each one I am going to point straight at the sentence, because the sentence is where the money actually gets decided, and it is the part that never makes the headline. There is also a 4th thing I'm going to give you today, and I want to plant it now so you stay with me. It is not a proposal. It is not a bill. Nobody in Congress is arguing about it. It is already law. It has been law for years, and for one specific person watching this, it is worth up to $250,000. It has a deadline. The deadline is measured from a date nobody wants to think about. And people miss it constantly, not because they were careless, but because the clock was running during the worst months of their life and no one told them the clock existed. If you have lost a husband or a wife in the last couple of years, that one is for you, and it may be the most valuable thing you hear this year. I will get to it. Stay with me. My name is Kevin. Every week I go looking for the rule that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because there is a great deal of noise about housing right now, and almost none of it tells you which sentence to read. Let us start with the one that has the biggest number on it. At the beginning of June, a congresswoman from New York introduced a bill called the Nest Egg Protection Act. Source. The Nest Egg Protection Act, House Bill 9064, was introduced in June by Representative Nicole Maliotakis of New York. Here is what it would do, and I want you to understand the size of it. Right now, when you sell the home you live in, the profit above a certain amount is taxable. For a single person, the first $250,000 of profit is protected. For a married couple filing together, the first $500,000. Verified card. Source. Current federal law excludes up to $250,000 of gain for single filers and $500,000 for joint filers on the sale of a primary residence. Anything above that line is taxed. And those 2 figures were set in 1997. They have not been raised $1 since. Not once in nearly 30 years. Verified card. Source. The home sale capital gains exclusion amounts have not been increased since they were established in 1997. Now think about what has happened to house prices since 1997, and you understand the entire problem in 1 second. A modest house bought for $100 and something thousand in a neighborhood nobody thought was fancy is worth $600,000 or $700,000 today. The owner did not do anything clever. They did not speculate. They painted it and fixed the roof and lived in it for 30 years. And when they go to sell it, the federal government treats a large part of that as profit and taxes it. That is the thing this bill is aimed at. It would raise that protected amount to $1 million. Verified card. Source. The proposal would temporarily raise the home sale capital gains exclusion to $1 million for qualifying homeowners aged 65 and older. And here is a detail almost every video about this has gotten wrong, so listen carefully. It is $1 million for a married couple, and it is also $1 million for a single person. The bill does not double the couple and leave the single person behind. It sets both of them at the same figure, which means if you are widowed or divorced or you simply never married, this proposal treats you exactly the same as a couple, and that is genuinely unusual in the tax code. So that is the number, $1 million. Now let me show you the sentence. To qualify, you must have owned that home for at least 25 years. Source. The proposal requires the homeowner to have owned the primary residence for at least 25 years to qualify. 25 years. Not 2, not 5, 25. And that one sentence quietly removes most of the people who are going to hear about this bill. Think about who it removes. The 70-year-old who sold the family house at 58 and bought something smaller does not qualify. The couple who moved once in their early 60s to be closer to a daughter or to a hospital does not qualify. The widow who moved after her husband died because that house was too much to keep up alone does not qualify. And I am going to give you my honest opinion about that, and some of you are not going to like it. That rule does not reward need, it rewards not having moved. It hands $1 million exemption to somebody who stayed in one place for a quarter century, and it hands nothing to somebody who moved once at 60 for a job or a sick parent or a marriage or a death. Those two people can be the same age, the same income, sitting on the same profit in the same town. One gets it, one does not. That is not a policy test. That is a coin flip based on how your life happened to go. And there is a second sentence in that bill that matters just as much, and it is about dates. It only applies to sales made in the years 2027 through 2030. Verified card. Source. The proposed increase would apply only to qualifying sales occurring between 2027 and 2030. Which means if this passes and you sell your house this year, you get nothing from it. The exact same house, the exact same person, sold a few months apart, and the tax bill is completely different. Now I have to tell you the most important thing about this bill, and I am not going to dress it up. It is a proposal. It is not passed. It is sitting in committee, and most bills sitting in committee die there quietly without a vote. Verified card. Source. The Nest Egg Protection Act has been introduced and referred to committee and has not been enacted. I am not telling you about it so you will count on it. I am telling you about it because if you are within a year or two of selling, the calendar in that bill is the only reason you would ever consider waiting, and nobody is going to write you a letter explaining that. Denton is 72. He lives outside Zanesville, Ohio. He bought his house in 1994 for a little over $90,000, and today, because his town filled in around him, it is worth well past $600,000. His wife died 4 years ago. So when he sells, he is a single filer, with $250,000 of protection instead of $500,000. Denton heard about this bill from a neighbor, and what he heard was $1 million for seniors. That is what gets repeated. That is all that gets repeated. What he did not hear was that he needs 25 years of ownership, which he has. And what he really did not hear was the year. He was ready to list the house this fall. If that bill passes and he sells this fall, he gets nothing from it. If he waits and it passes, on his numbers, we are talking about a very large amount of tax he simply does not pay. And if it does not pass, he waited a year for nothing. That is the actual decision in front of Denton, and it is not a comfortable one. But notice what it is not. It is not a decision he can make by hearing a number on the television. It is a decision he can only make by knowing which sentence applies to him. And that is exactly why I put the quiet rules together. Because the problem is never that people are careless with their money. Denton is not careless. The problem is that everything that decides what happens to the largest asset you will ever own is written in language nobody translates, in bills nobody reads to you, with the deciding sentence buried 3 paragraphs below the number. The quiet rules is everything I cover on this channel in one place, written large and written plain. What the real thresholds are and which one applies to your situation. What paperwork decides the size of your tax bill. The exact words to use when you call so the person on the other end knows what you are asking for. So that when the week comes where a decision like Denton's lands on your kitchen table, the answer is already in a drawer instead of being figured out in a hurry. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top. And there is a 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. Because the alternative is a widower listing his house in the wrong season, over a sentence nobody read out loud to him. And there is a second bill on this same subject that almost nobody is talking about, and for most of you it is the better one. It is called the More Homes on the Market Act, and it takes a completely different approach. Instead of $1 million for a narrow group, it simply doubles what already exists for everybody. $500,000 for a single person, $1 million for a couple. And then it does the thing that nobody ever does. It ties those figures to inflation, so they rise on their own from then on. Verified card. Source. The More Homes on the Market Act would double the home sale capital gains exclusion amounts and index them to inflation going forward. No age requirement. No 25-year requirement. No 4-year window. Now hear the difference between those two bills, because it is the whole lesson of this video in one comparison. One of them has a bigger number and a sentence that removes most people. The other has a smaller number and no sentence at all. And if you only ever heard one of them mentioned on television, I can tell you which one it was, because $1 million makes a better headline than indexing to inflation. That is the entire reason the second one is invisible. I will give you my opinion plainly. Fixing a figure from 1997 so it stops falling behind every year is worth more to ordinary people than a large exemption aimed at a small group. The unglamorous bill is usually the better bill. It is also usually the one that dies quietly. Now let me give you the second one, and this one is not federal at all. In April, a state senator in Pennsylvania introduced something with a bolder idea behind it than anything moving in Washington. It is called the Sam Worley Elderly Tax Relief Act, and it is named after a World War II veteran who was still paying property taxes in the 100th year of his life. Verified card. Source. The Sam Worley Elderly Tax Relief Act was introduced in the Pennsylvania Senate and is named for a World War II veteran who paid property taxes into his 100th year. Sit with that for a second. A man who fought in that war was still writing a check to his county at 99 years old for a house he had already paid for. What the bill would do is simple, and it is enormous. If you qualify, your property tax does not get reduced. It goes to nothing. School, county, and municipal, all of it, gone. Verified card. Source. The proposal would provide a full exemption from school, county, and municipal property taxes on a qualifying primary residence. Now here is the sentence. You must be 75 years of age or older. You must have lived in Pennsylvania for at least 10 consecutive years, and you must have owned and lived in that same home for at least 10 consecutive years. Verified card. Source. Qualifying homeowners must be 75 or older with 10 consecutive years of state residency and 10 consecutive years of ownership and occupancy of the primary residence. Same shape as the last one. The number is the headline. The calendar is the law. 75, not 65. 10 consecutive years, not 9.5. But there is one part of this bill that I want to give real credit to, because it fixes something that ruins people constantly. If the qualifying spouse dies, the surviving husband or wife keeps the exemption, at any age. Verified card. Source. The proposal allows a surviving spouse to retain the exemption regardless of age, while the home remains their primary residence. That matters more than it sounds. Because the standard way these programs are written, the benefit is attached to the older spouse, and when that spouse dies, the benefit dies with them, which produces the cruelest arithmetic in this entire subject. A woman loses her husband, and in the same season she loses part of his Social Security, and then a tax bill she has not seen in years reappears in her mailbox. Grief and a bill arriving together. Whoever wrote that provision had actually met a widow. That is not a small thing, and I will say so. Now, two honest cautions, because I am not going to sell you something that does not exist. That bill is a proposal in one state. It is not law in Pennsylvania, and it is not law anywhere else. And no state in this country has ever eliminated property taxes outright, so the money would have to come from somewhere, and nobody has explained where. Verified card. Source. No state has fully eliminated property taxes, and proposals of this type raise questions about replacement revenue for schools and local government. So why am I spending time on a bill in one state? Because states copy each other. That is how nearly every senior tax protection in this country spread. One state writes it, it works, or it polls well, and within a few years the same language shows up in a dozen state houses. If you are watching this from Ohio or Texas or Florida, the version that eventually reaches your legislature will probably look a great deal like that one, right down to the 10-year requirement. Which means the clock on your 10 years may already be running, and the only thing you have to do about it is stay put and know it exists. And that brings me to something that costs people more money than any bill in this video, and it has nothing to do with Congress at all. It is a shoebox problem. Here is how the tax on your house actually gets calculated, and almost nobody understands this part. They do not tax what you sell it for. They tax the difference between what you sell it for and what the house cost you. And that second figure is not just the purchase price. Every permanent improvement you ever made to that house gets added to it. Verified card. Source. The cost of capital improvements is added to a homeowner's basis, which reduces the taxable gain when the home is sold. The new roof. The furnace. The addition off the back. The kitchen you redid in 2004. The bathroom you made accessible when your knees went. The siding. The windows. The driveway. Every one of those raises the number they subtract, and every dollar you can prove is a dollar they do not tax. And here is the part that hurts. The proof is a receipt, and almost nobody has 30 years of receipts. Emmett is 78. He lives in Enid, Oklahoma. Over 31 years in that house, he put in a new roof twice, a furnace, central air, a garage, and he redid the kitchen after his daughter got married. He remembers all of it. He can tell you which summer each one happened and which contractor did a poor job. What he cannot do is prove any of it, because his wife kept the folder, and the folder is gone. So when he sells, the government will start counting from what he paid in 1995, as though the last 31 years of work never happened. Now I want to be straight with you. There are ways to reconstruct some of this. Contractors keep records. Permits are filed with the county and they sit there for decades. Old bank statements show payments. Insurance claims show roofs. None of it is as good as the receipt would have been. And here is the version of this that I actually want you to act on, and it is not for Emmett. It is too late for Emmett. It is for whoever is watching this who is 62 and just had the roof done. Put the invoice in a folder today. Write the year on it. Put the folder somewhere your spouse and your children know about. That folder is worth more than any bill in this video, and unlike every bill in this video, it does not require anybody in a Capitol building to vote on anything. Now let me pay off what I promised you at the beginning. Everything I have covered so far is a proposal, a maybe, something that might happen if enough people in a building vote a certain way. This next one is not. This one is already law. It has been law for years. It is sitting in the tax code right now, and it is the single most valuable thing in this video for one specific person. Here it is. When a husband or wife dies, the survivor becomes a single filer, which normally means the protection on a home sale drops from $500,000 down to $250,000, cut in half, in the same year you buried them. But there is a provision that says if you sell the home within 2 years of the date of your spouse's death, you keep the full $500,000. Verified card. Source. Internal Revenue Service guidance provides that a surviving spouse may exclude up to $500,000 of gain if the home is sold within 2 years of the spouse's death and other conditions are met. 2 years. From the date of death. Not from the funeral, not from when the estate closed, not from when you felt ready. From the date on the certificate. And past that date, the protection is $250,000, and there is no appeal, no hardship exception you can apply for, and nobody at the county is going to call and warn you the window is closing. There is a second piece to this that works in your favor, and I want you to know about it. When your spouse dies, their share of the house gets revalued to what it was worth on the day they died. Verified card. Source: a deceased spouse's interest in jointly owned property generally receives a basis adjustment to fair market value as of the date of death. In most states, that revaluing applies to half the house, their half. In a handful of states with community property rules, it applies to the entire house, which can erase the taxable profit completely. Verified card. Source: in community property states, the full value of the residence may receive a basis adjustment at the death of one spouse, while in most other states only the decedent's share is adjusted. Confirm state treatment before recording. So for some widows, this entire question disappears and there is nothing to pay. And for a great many others, in most of the country, half the house was revalued and the other half was not, and the 2-year window is the difference between owing nothing and owing a very large check. The trouble is that you cannot tell which one you are from the couch. It depends on your state, and on how the deed was written when you bought the place 40 years ago. Which is exactly why the 2-year clock matters. It is the one part you control. Lurline is 69. She lives outside Chillicothe, Missouri. Her husband died in the spring, 3 years ago. They had been in that house since the early 80s. The first year, she did not sell because she could not. Anybody who has lost somebody understands that year. The second year, her son started saying the house was too much for her, and she agreed with him. And she still did not do anything because agreeing and acting are two different things when you are grieving. She listed it about 2 years and 4 months after he died. 4 months. And nobody had ever told her that there was a date. Not the funeral home, not the bank, not the lawyer who handled the estate, not the agent who listed the house. She was not careless. She was widowed. Those are not the same thing, and I will not have anybody confuse them. Now, if she had known, would she have rushed a decision like that to beat a deadline? Maybe not. Maybe she would have chosen the extra 4 months anyway, and that would have been a fine choice. But it would have been a choice. She never got to make it. She simply drove past the date without ever knowing it was there. That, right there, is the entire reason this channel exists. Not because these rules are complicated, most of them are not. Because nobody says them out loud to the person they apply to at the time it would matter. The funeral home is not going to say it. The bank is not going to say it, and the tax code does not mail anybody a warning. Everything in this video comes down to knowing one thing during one specific season of your life. The season a spouse dies, the season a house goes on the market, the season a bill actually passes. That is precisely what the Quiet Rules is built to be sitting in the drawer for. The thresholds and which one applies to you. What to do in the first year after losing a spouse and in what order. What to keep and for how long, and what it is worth when you sell. Written plain in one place so it is already in the house before the season arrives instead of being learned afterward. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked. Because the alternative is a woman in Missouri who lost her husband and then lost $250,000 of protection by 4 months over a date nobody said out loud. Now I want to say the most uncomfortable thing in this entire subject, and then I will give you your list. If you keep that house until you die, your children inherit it at what it is worth on the day you die. Which means the entire lifetime of appreciation, every dollar of it, is simply never taxed. Verified card. Source: inherited property generally receives a basis adjustment to fair market value at the date of death, which can eliminate tax on appreciation during the owner's lifetime. Now hold that next to what happens if you sell. Sell it while you are alive and past your exclusion, you are taxed. Die in it, and nothing is taxed at all. I want to be careful here because I am not telling anybody to organize their life around a tax code. Please do not. If that house has stairs you should not be climbing, sell the house. No exemption in the world is worth a fall. But you should know what the arithmetic is, because right now the tax code pays you more to stay in that house than to leave it. And that is not a loophole somebody found. That is how it is written. Economists have a polite name for what that does. They call it the lock-in effect. Older people staying in houses they no longer want because moving is too expensive. Verified card. Source: analysts describe a lock-in effect in which longtime homeowners delay selling due to the tax consequences of realizing accumulated gains. And every bill in this video is an attempt to fix that. That is the actual thing Congress is arguing about, not whether to be generous to seniors. whether it is worth loosening the one rule that is currently keeping several million houses off the market. You are not the target of that debate. You are the leverage in it. I would rather you heard that from me than from a headline. Now, before I give you your list, one warning, because this exact subject attracts a specific kind of operator. The moment there is talk of housing relief for seniors, the letters start. Some of them offer to file your property tax exemption for you, for a charge. Some of them offer to send you a certified copy of your own deed, for a charge, on paper that is made to look like it came from the county. Every one of those forms is free at your county office, and a copy of your deed costs a few dollars from the recorder if you ever actually need one. And there is a newer version worth naming because it targets exactly the people in this video. Somebody calls about the equity in your home and offers to help you access it, and what is actually being signed over is more than anybody explained. The rule is the same one I give for everything. If somebody came to you about your house, that is the one to be careful about. If you went to them, you are usually fine. If you want a second set of eyes on your own situation, whether the ownership clock on your house works out the way you think it does, or where your 2-year window actually falls, email me. The address is on your screen and in the description below. I read every one. Now here is your checklist. 5 things. 1. Find out today, not eventually, what year you took title to your house. The deed is at your county recorder and it is public. Every proposal in this video counts years of ownership, and you cannot count them until you know the starting date. 2. If you have lost a husband or a wife in the last 2 years, write the date of death on a calendar and count 2 years forward from it. Circle that date. If selling is anywhere in your thinking, that circle is the most valuable mark you will make this year. 3. Start the folder. Every improvement, every invoice, every permit from today forward in one place your family knows about. If you have already sold or improved without receipts, call your county about old permits before you assume it is lost. 4. If you are close to selling and close to 65, do not decide anything based on a headline about $1 million. That bill has not passed, and it has a 25-year requirement and a date range in it. Find out whether either one even applies to you before you let it change your plans. 5. Call your county assessor and ask what senior exemptions, freezes, or deferrals exist at your address right now and what the deadline is for each one. Because while everyone is watching Congress, the relief that already exists is at the county level, and it always requires you to apply. Here is what I want you carrying out of this video. Denton was ready to sell in the wrong season because he heard a number and never heard a date. Emmett did 31 years of work on a house and can prove almost none of it because the folder went missing. And Lurline drove past a deadline in the fog of the worst year of her life and lost $250,000 of protection by 4 months. Not one of them did anything careless. Not one of them was denied by anybody. Every single one of them was on the wrong side of a sentence they had never been shown. And that is the thing to hold on to. The number is always the part they tell you. The calendar is always the part that decides. Congress is going to keep announcing numbers. Some of those bills will pass and most of them will not. But underneath all of it, the rules that actually decide what happens to your house are already written. They are already running, and every single one of them is counting years while you are not looking. Go find out what your dates are, this week, while nothing is wrong. That is the whole assignment. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.